In some other news, a trending topic in the ETF space is defined outcome or buffer ETFs. JD Durkin spoke with Innovator ETFs VP of Capital Markets and Institutional Strategy to learn more about it. Let's take a look.
So a defined outcome ETF was the first ETF that allowed you to know your parameters at the onset of investment. So defined outcome means you have a buffer and you have a cap, a known level of protection on the downside and a cap on the upside. The third thing you have to know is it has an outcome period. So it could be 3 months, 12 months, 24 months. And at the end of that outcome period, it resets within the ETF ticker. So really taking that traditional structured note type payoff, bringing that into the ETF wrapper.
And you're seeing a lot of inflows right now. What is the volume? What does the interest look like in the space?
A lot of demand this year. Q1 was actually a record quarter for flows for defined outcome ETFs. Innovator itself manages about 25 billion. The space is just over 50 billion. We view this, you could probably add a zero to the AUM of this space the next 5 to 10 years. We're seeing this across hedge equity, fixed income replacement, you name it.
What's driving the surge of adoption and overall interest, you think? What are those real underlying gravitational forces?
I think it really is the structural alpha of the ETF wrapper. So this type of payoff, I mentioned it before, has been around for decades, just in the structured note wrapper. When you take that exposure and you shepherd it into the ETF wrapper, it unlocks liquidity, tax efficiency, transparency, no credit risk, all the things that folks look for in a more scalable investment.
What are the biggest concerns you hear from investors?
The big thing is just that upside cap. So you're capping your returns, right? So you have to think about your cap. What kind of return profile are you looking for? Are you buying the ETF at the right time? But we always say we have a variety of different outcome periods. We have funds resetting every single month. So there's always a great outcome period for you to enter into.
Do you ever hear concerns from hedge funds about the general buffer ETF space? And if so, I wonder what those conversations look like. And I hope you don't mind me asking.
No, it's a great question. It's been in the news a lot recently. There's a big legacy active manager who will not go named in the Northeast that was taking some shots at buffer ETFs recently. From our perspective, there's a couple arguments made, and I'll point to one to start. The first is, why don't you just reduce your equity exposure instead of using a buffer ETF? Why don't I just go a little bit less stocks, a little bit more cash? On the surface, that could make sense. But when you think about what a buffer ETF really does, it delivers you a defined outcome, a non-linear payoff. So you can't just reduce your stock exposure because you still don't have a defined outcome. When we talk to advisors and institutions, they like the idea of knowing their parameters before they invest. And you can only really get that with options in the ETF wrapper.
What's the Yukon endowment component of all of this? I know that that's kind of an interesting little quirk or side note to the overall story. It's a fascinating one.
Yes, that's a client that was willing to go public and talk about their allocation. David Ford is the chairman of the investment committee over there. They replaced all of their hedge funds, or at least the majority of their hedge funds, with buffer ETFs. That was a landmark move in the endowment space because traditionally those hedge funds have been really popular with institutions. The reasons were really simple, and it's the reasons we've talked about: liquidity, tax efficiency, transparency, and that ability to communicate their outcomes. If you're with a hedge fund manager and they underperform, you don't really know how to explain it. With a defined outcome ETF, you know what your outcome is at the onset of investment.
Yeah, sometimes liquidity is hard to come by. It's hard to find, and I'm curious how you see the general buffer ETF space as sort of addressing some of those concerns when liquidity isn't exactly there all the time.
Yes, liquidity is a big story right now. We're hearing it from advisors, financial advisors, institutions in the form of endowments, foundations, and pensions. They're filled to the gills with private equity and private credit. They've been sold that over decades, and they're looking for liquidity at this point. So they're taking a hard look at their hedge fund sleeve, those underperforming managers, and they're saying, you know what, this could be a place where we replace some of that exposure with a buffer ETF because they're daily liquid. They trade every single day on the exchange.
Is there a reason they're prioritizing liquidity more so now than they previously have, or is that a bit of a misreading?
No, it is. Right now, they're definitely prioritizing liquidity more now than they had previously for a couple reasons. The first is, on the private side, those distributions have been drying up on the private equity. The second is, in the federal sort of landscape right now, a lot of these endowments are getting less funding from the federal government, which is a big deal. So the liquidity is a lot lower. So they're looking for tools that unlock liquidity for them, and the buffer ETFs do that.
What do you think is next for innovation in terms of overall ETF structures? Where do you see this puck going, which I know is always easier said than done, but I'm fascinated with your take on it.
There's a lot going on in the derivative ETF space. There's so much you can do when you take options and put them in the ETF wrapper. From our perspective, we started with buffers at Innovator ETFs. You're going to see all sorts of interesting structured note payoffs like dual direction and auto callable, which is an income strategy. We aim to take those structured note payoffs, shepherd them into the ETF wrapper using options.
How are derivative-based strategies evolving, if at all, inside these types of ETFs?
It's an extension of what we just talked about. It's going to be taking those structured no payoffs and bringing them into the ETF wrapper. It unlocks so many benefits when you put it in the ETF. I talk with advisors, they do not want to manage options on their own. I don't think any of us do, frankly. So if we can package that in the ETF wrapper and make it simple for folks, they appreciate that.
Burke, Ashenden, thanks again to him, Innovator ETFs VP of Capital Markets and Institutional Strategy, joining JD Durkin for that interview.